Welcome to another edition of the course Foundations of Accounting and Finance. Now we are at the third part of this course, third and the last part. That's what we talk about. We talk about from accounting, we slowly move towards what we call as finance, the corporate finance part of it, corporate finance, business finance, finance part of it. As indicated in the first session, I am sticking to these three prescribed textbooks. These are the three textbooks from which I have picked up numericals. These are the three textbooks from which I have picked up some of the material for teaching, some of the PPT slides, etc. And these are the textbooks which are recommended for these courses out there. That is what I indicated in the first part, and I am again stressing it. Most of the financial accounting picked up from accounting test and cases, Robert Anthony and Hawkins and Merchant. The large part of cost accounting part of it and management accounting part of it picked up from management accounting, Garrison, Noren and Beaver. Large part of corporate finance I will be picking up, of course, from Ross, Westerfield, Jaffe, Jordan and Kakani. These are the, what do you call it as, reference or sorry, the textbooks prescribed for this course. Now, question is, what is business? What is corporate finance? What is business finance or corporate finance? What does it do as a function? What is the objective? Core aspects as listed on the slide, you can see three things. One, to raise money for any long-term investments of the choice of the firm out there. For example, the firm chooses to put up a manufacturing facility of a particular product, etc., then it is a long-term investment out there. The amount of money that is getting into that basic putting up that entire manufacturing facility, the entire cost related to that is a long term, because you are going to derive benefit from that firm for a very long term out there, and the cost of purchase of the plant, machinery, space, constructing the building, etc., etc. What I am looking at, I am looking at a long term investment. I need to look at source money. And what are those kinds of long term investments that I should choose? Because I can choose an array of investments. I can choose for putting up a manufacturing plant. I need not put up a manufacturing plant. I can put up what is called as I can sort of go back and go out and invest money in another country, in a manufacturing plant, in manufacturing, whatever. So, specifically there is a choice. I can put up a plant out here in Tamil Nadu, I can put up a plant in Karnataka, I can put up a plant in northeastern part where I can get some tax benefits, I can put up a plant in Maldives, I can put up a plant in Mauritius, whatever it is. Now, I have to choose, and what kind of product, etc., all those aspects. How is it related to my company? What the entire thing. So, what long-term investments should the firm choose? That is the core aspect. What is that specific aspect of long-term investment that I have to choose out? Now, how should firm raise this money? That is what I in fact started off with it. To make this investment, I know which project is going to be most feasible for me is what I decide. I have three options. I can invest in a manufacturing plant in Tamil Nadu out here in India. I can say I don't want to invest in a full manufacturing plant, I am going to invest in part manufacturing, the other part I am going to buy it out there. That is the second option I have. Third option, I can put up the same manufacturing plant with some benefits out there in some other state, some other state. But I will have, for example, I said northeastern state, but I will have extensive cost of logistics if I put up the plant there in northeast. So now what happens? There are 3-4 choices you have. Now, which is the best possible option for you, that is what you will decide. Which is the best possible option for you, given the kind of returns and everything out there, that is what you will choose. That you will choose depending on, so among these choice, which is the best possible long-term investments for you or firm, you will choose. That depends on a lot of other factors. We will come to that. People will say time value of money, yes. Returns, yes. We will look at all those aspects. Second, for making such investment, how should I raise money? Should I raise money in the form of equity? Should I raise money in the form of debt? In equity, should I go in for an IPO? Should I go in for a private placement? In debt, should I sort of raise the debt in India? Should I sort of raise public debt? Should I sort of go in for what do you call it as a private placement of debt? Should I sort of go in for a foreign currency debt? All kinds of options out there. Now you see the choice. Number one is to invest. Which is the project to invest? There are half a dozen choice I have. Which is the one I have to invest? The one I have to invest should give me maximize my return. Of course, yes. Keeping the risk part of it. Second aspect out here, what we are looking at is how am I going to raise the money for that particular investment? That is also required in this case. So the two basic aspects. One is sourcing the fund, because imagine, let us take example. I am into an infrastructure project. I am looking at a 30-year road project out there. I'm basically, you would have traveled all the toll roads out there, the concession agreements typically. The road project, what happens? The investment, I make a road, PPP, public-private partnership. Let's keep all that aside. Let's not get into the complicated at the basic first class. Imagine I take up a project to build a road for about, say, 50 kilometers. And I spend something like about 30,000 crores on that project. Now, how will I get the money back? That is the choice what I have made to build a particular piece of road, and the cost is 30,000 crores out there. I have basically chosen that project. What is the basis? Let's not worry about the basis. Now that 30,000 crores, I have to make an investment. When will I get the return back? When will I get the 30,000 crores back? The principal and what do you call it, the return on the principal. Spread over a period of 25 to 30 years or 20 to 30 years. Because what happens, the infrastructure projects are such that the time to recover the money and as well as what you call a service that investment as well as recoup the investment, it takes about 20 to 30 years. That's what they call concession agreement. So now, if I know that I'm going to invest in a road project 30,000 crores and it's going to take about 25 to 30 years for me to get the money back, I cannot go and raise money by issuing a 5-year debenture. If I issue a 5-year debt instrument and raise money and then invest in this infrastructure project out there, that is the road project, at the end of 5 years, the fellows from whom I have borrowed money will come back and say, give me my money back. Will I have the money? No, because the project in which I have invested, it will take 30 years for me to recover the money. So I have to source money from an avenue which is going to be, who is investing in me for 30 years out there. So what happens? I issue a long-term bond, 10-20 year bond, a 30-year bond. I raise money on that bond. I invest in a road project. So as and when I keep getting money on the road project, I keep servicing the bond out there, and then basically I'm taking care of it. ALM, asset liability management issues. So what happens? Raising money for the kind of investment, that is also very tricky. The kind of investment, the risk involved in the investment. Why? Second thing, here I talked about only the time aspect. There is also a risk aspect. Imagine I want to go around and play in the stock market and I raise money. Somebody who is going to give me money to play in the market is very unsure, because it's highly risky. He is very unsure how is he going to get the return. So what is happening? Because of uncertainty, what is he going to do? He is going to say my expected return is going to be X, Y, Z, etc., which is going to be little higher in that case because risk is high. So what happens in this particular case? I have to raise money in such a way that I have to raise money in such a way that not only the time required for my investment, also what is called as the risk aspect also is sort of taken care of. Given all that, I will have to look at raising money at the lowest possible cost of it. Because as the risk of my investment increases, the cost of my funds increases. So what happens? I will choose a relatively less risky investment so that my cost of funds come down. So is it always the case that I have to choose a project which is always less risky so that my cost of investment, my cost of raising fund is always low? Well, it may not be so. There are certain projects inherently the risk is high. When inherently the risk is high, the cost of funds will also be little high out there in that particular case. So you are looking at among the options choosing the best investment, among the array of options available to raise funds, choosing the best possible way to raise funds and sort of trying to match that out there. And that is what we will learn in corporate finance or business finance. The third aspect in this slide, short-term assets to be managed in finance. Typically, we call this as working capital management. What do you mean by working capital management? Imagine, let's take a very simple example. I sell goods on credit. I sell goods on a 30-day credit. That means I am selling the goods, he is going to pay me after 30 days. Perfectly all right. But I am inefficient in collecting, so my average collection period moves from 30 days to 45 days. Agreed? Now what happens? Based on the idea that I am giving a 30-day credit, I am procuring my raw material, and when I procure my raw material, he is giving me only 10-day credit. He is not giving me more than that. So what happens? I have to pay him in 10 days, but I am going to get the money in 30 days. So I go out and borrow money, come back and pay these guys. So it's happened. But what happens? The 30-day inefficiency, it is increasing to 45 days. It's average. So my requirement for borrowing is consistently going up because I am not able to raise money from the sales to repay these guys. So what happened? Constantly my requirement for money is going up out there. That is one aspect out here. How do I manage? Second aspect, you cannot keep money idle. Imagine you are making purchases only once or twice a month. And when you make purchase, you pay cash and buy. Let's imagine. You sell only on cash. But your sale is continuous. Your sale is continuous, your purchase is only once a month. On the first of every month, you make a purchase and then you keep it in stock and you keep on selling it throughout the month. And every day you sell, you are getting money, cash. So what do you do with that cash? Keep the cash locked in a cash box or just deposit money in the bank account and keep it there? Well, no, that is not the choice. Because idle money does not grow. If I am an individual and I am investing in your company and your company is every day that is collecting cash and keeping it idle, then you are not going to give me the kind of return that I am expecting. Instead of you keeping it idle, I myself will sort of keep investing the money. So what you will have to do? You will have to do some kind of a treasury operation out there. What is a treasury operation? As and when I have excess cash, I am finding avenues to invest marketable securities. and I should be able to liquidate those securities as and when I require the money. That is, on the first of next month I require the money to pay for the purchases. Around that time I should be able to liquidate it, get the money, pay for the purchase, and as and when I keep getting, I should be able to park the money somewhere which is going to earn some more returns out there. Sir, I invest in the market goes down on the first, so I lose money. Well, that is where treasury function becomes important. Not that you just blindly go and invest everything in the stock market out there. You will have to choose your investment options. There are array of investment options available. You have to choose your investment options, you have to hedge your risk, and then you have to place them, park the money in multiple places so that you are able to raise the money as and when required and then meet your obligations out there. So that is what the third aspect. So in a nutshell, if I have to talk about all these three, first thing in a corporate finance, what is it you have to do, or a business finance? You have to choose the best possible option to invest among the choice that you have, or from the choice that you have. You have to choose the best possible investment options where you have to put the money from among the choice that you have. What do you mean by best? Best in terms of depending on your risk appetite, best in terms of your return, best in terms of your what is called as your other long-term costs because of that, and so on and so forth. I said I invest in Northeast. Cost, everything in return is high in general, but my transportation cost, my logistics cost is going to be humongous because it's in Northeast. So what is happening? That is going to eat into my return out there. So various aspects you have to consider. Choose the best possible option to invest from among the choice you have. Now, choose the best possible option to raise money for meeting that investment, or for meeting that investment that you have basically chosen out there. For the investment that you have chosen, choose the best possible source of your funds out there. Of course, that investment would also depend partly on the source itself. Third, look at short-term money management, working capital, day-to-day operations out there. These are the three basic aspects that we cover in corporate finance or business finance. Now we go ahead further. I am going to go a little bit in detail about all this. I want to talk about balance sheet. This is from the textbook out there, Stephen Ross. Exactly. Typically, when we talk about value of the assets, we are talking about current assets, fixed assets, etc. As an investor, what am I worried? I am worried about the total firm value. That is, what is the firm value out there? I have the shareholders' equity out there, minus your debt, minus your liabilities out there. That will give you value of my equity out there. To my investor, I am looking at total value of the firm, or etc. That it basically depends on what you see on the left hand side out there. When we talk about the next decision, capital budgeting decisions. Now, I said fixed assets, tangible, intangible. What long-term investment should a firm choose? That is what we talked about in the first case. That depends on your equity and long-term debt, shareholders' equity and long-term debt, because that is where it is your source of funds out there, as you can see on the next slide. How should the firm raise money on the selected investments? And then basically what happens in this particular case, how do you meet your short-term obligations, your current liabilities and your current assets? That's all. To be going back, how should the firm raise money? I have included the current liabilities part of it also here, but predominantly it is restricted to debt and equity. What is the long-term investment that you choose? Basically the fixed assets part of it. Where is it? You have to invest. How are you financing it? Debt and equity. Keep the current liabilities away. Working capital, just the relation between the current liabilities and the current assets out there. That's all. Now, usually if you can actually see this, this is the typical structure of what you call it as the finance department of any large organization. Typical structure. Sir, will the designations be exactly like this? May not be. There could be some changes in designations out there, the way in which each organization calls it. For example, Sahara Group never called CFO, CEO or etc. They always called chief worker. That is what they used to always use the word worker out there. So it all depends on the organization. I'm just taking out of context out there. But this is the normal structure out there. That is, it is always headed by, the finance activity is headed by, they would call it vice president or senior vice president or whatever it is, or a CFO, chief financial officer, etc. He is a person who basically takes care of the finances out there, the entire part of it. He reports to the CEO or the MD or the chairman of the board and so on, if it's a duality and everything, and of course the board of directors. So below him, how does he function out there? There are two basic aspects what he talked about. There is a treasury function, treasurer function, or a controller function, financial controller function. The treasurer part of it looks at the cash management. Cash management means where to invest short term, how to get money when you want, for example, where to park the money, excess cash, and where to borrow for a short term, what is the best way to borrow, etc. Cash management. Talks about also credit management out there. Because I am giving 30-day credit on my sale, I am getting only 20-day credit. That means my requirement for cash is more. Immediately you will go and say advise. No, basically renegotiate with the purchase so that you extend it to 30 days, or renegotiate with the sales so that you bring it down. Somewhere the credit part of it. He also takes care of capex. Capex means additional investments, any capital expenditure that are required and so on and so forth. Capex requirement, capital expenditure, purchase of new machinery and so on and so forth. And of course your financial planning, overall financial planning for the organization. Then the other part of it, the controller part of it, more typically, if I have to say, it is the what do you call it, the typical accounting managers out there, the typical accounting, the cost accounting who will take care of the product cost, unit cost and etc. The financial accounting part of it who will sort of keep account of every transaction that is basically happening out there. An IT person who will integrate all these things. An internal audit who is going to be auditing all these things. That is what we call it. In fact, in this case, he is a tax manager. Normally, who will take care of what is called as the compliances in terms of government compliances, everything. There is going to be an internal audit function who is going to be auditing the entire transactions out there. And it will all merge and then move to the CFO and then to CEO and so on out there. This is a typical structure how organizations work out.